model to price the equity or evaluate equity. And also you need to know different forms of model to price the short-term bond and long-term bond. Okay. And the last point is about the term structure of the interest rate. So for the equity valuation or valuation of a common equity, we do have a lot of ways. Okay, we do have a lot of ways. It's not necessarily just the dividend growth model. So probably you may heard like multiple ratios, right? Sometimes we use the PE ratio or enterprise to earnings ratio and use them multiple ratios to estimate the equity value. And sometimes we can also look at the free cash flow to the equity holder, right? And calculate the present value of all the free cash flows to the equity holder. And obviously there's another traditional model we call the dividend model. And this dividend growth model is actually from the investor's perspective. Okay, from the investor's perspective. So think about the reason why you want to make an investment in equity. Because you anticipate to get income in the future, right? And that income should be relevant to the equity. And then obviously you have to think about what should be the relevant income by holding equity. Right? If I can get more income in the future, I'm willing to pay higher price right now. So by holding equity, the relevant income or cash flow, dividends. I may get dividends in the future, right? What else? It could be capital gain, right? If I can sell the equity in the future at a higher price, I can get a capital gain, right? That's the relevant cash flow by holding equity from the investor's perspective. And the dividend growth model actually captures this point. We want to know what is the present value of all the future income by holding equity. And that present value should be the price of the equity at right now. Okay? So that's why, so this is about share return. So that's why we can use some general forms to calculate the present value of all the dividends that are going to be paid by the company. And obviously there should be assumption for this model. All right. First of all, the firm will never go bankrupt. So that's why the company can continuously pay dividends to the investors. Okay? And also the dividends should not be too volatile because that will make the investor hard to predict the dividends in the future. Okay? Not too volatile means that today or this year, the company paid $2. Next year, company just paid 0.2, right? The year after next year, the company paid $10. So very volatile. Okay, that will make the investor really hard to predict, right? What could be the dividends in the future. And this is quite important because any valuation method is a forward-looking. Okay, it's forward-looking. So the price is actually determined by the future cash flow, not by the past. So when we do the valuation for any securities, we have to forecast the relevant cash flow in the future. Okay? That number may not be true in the future because you will never know what's going to happen in the future. It's just based on your projection, right? Based on the information you have. So that's why the prediction is quite important. The projection is quite important when you evaluate the equity price or security price. And obviously, different people may have different projection. You may actually come up with different numbers for that equity evaluation. So that's the problem in the real world. But obviously, in this course, we will give you the number directly, right? What could be the numbers in the future. But this number is actually the most difficult part in the real world when you want to value the equity or value any securities, is to predict the future cash flow. So anyway, back to this model, right? The intuition behind is the companies will pay dividends, right, indefinitely. And if we can calculate the present value of all the future dividends I expect to earn, that should be the price of the equity. Okay? Well, you may have a question. It seems that this model assumes that we have to hold the company shares forever, right? Because there's no capital gain. There's no cash flow related to the share sale in the market. Well, a more general form, right? We can have a more general form to evaluate the equity. So the first part is the present value of all the dividends till the point that you sell the equity, right, in the market. And PN is the time point that you're gonna, PN is the price, right, at which you sell your equity in the market in the future, right? And this is the relevant cash flow for your investment period. Okay, this is more general form. Well, now the problem will be the PN now. So price at different time points will be different. If you sell the equity 1 year later, it may be $12, but 2 years later, that price can be $24, right? So if we sell this equity in the market at different time points, will that influence our equity price now? Alternatively, can we say, will the timing of the equity sale influence our current price? Right? Different investors may have different investment horizon. You may want to hold 3 years, others may want to hold 5 years. So does your investment horizon influence the current market price of the equity? Any guess? Right. This also matters for the dividends. Hold 3 years, you get 3 dividend payments if the dividend is paid every year. But if you hold 5 years, you get 5 dividend payments. Obviously, the second scenario, you get more dividends. Right. It seems like the price will be higher. Right. So that's related to the price we're gonna assume. Okay. For this case. So the price you're going to sell the equity share in the market will be determined by the cash flow, by the dividends beyond the time point or beyond the time point of this equity sale. Okay? So for example, if you want to sell the equity 3 years later, and that price is actually determined by the expected dividend after year 3. Okay, after year 3. If you want to sell the equity in year 5, the price, even though it's different, but still is determined by the dividends you're going to receive after year 5. Okay, so let me just give you some numerical equation. Okay, so here we just give you 2 scenarios, and they will actually give you the same result. So the first scenario, let's say the investor will hold for 2 years and sell the share at year 2, and let's suppose the price is P2, right? So using that formula, P0, right, is determined by the 2 dividends you got and also the price, right, you sell the security in the market 2 years later. All right? Any question with this equation? That's just the general form for, right, the equity price. Now back to the question 1. How we can know the price that will be, the equity will be sold? P2. So P2, the price, as we mentioned, will be determined by the dividends that beyond that time point. So P2 will also determined by D3, D4 till the end. Okay? And then you can plug in this equation back to 1. Okay? And finally, you can get the general form for that equity price. It equals to the present value of all the dividends in the future. So even though we don't have a capital gain in this expression, but it implies, right, it actually incorporates that information because the dividends will actually determine the price you're going to at which you're going to sell the equity. Okay, so the same idea for the scenario 2. Let's say 3 years investment period, 3-year investment horizon, 3 dividends you're going to receive, and also the price is P3. Okay, and P3, the price at year 3 will determined by the dividends after year 3. Okay, so you plug it back, plug it into the equation 1, and again we have the same expression. Okay, so P0 is still the present value of all the future dividends. So that's why we said this equation does not ignore the capital gains. The present value, the sum of all the present value of future dividends. So this equation does not ignore the capital gains. It actually incorporates that information, right? And you can tell from these 2 different examples. The dividends, it can actually incorporate the price information because the dividends will determine the price, the future price that the equity will be sold in the market. Okay, anyway, so here just want to highlight this issue. Don't be confused by the general form here, why we don't have a capital gain, right? By holding the equity, you should have a capital gain, you should have dividends. But the dividends actually incorporate the information of the capital gains. Okay, so next, probably just look at some simple example by using the general form. So XYZ company, the company will pay an interim dividend of $0.5 in 6 months, another dividend $0.5 in another 6 months, in 12 months time, and the share will be you also expect to sell the shares at $12 in a year time. So if the required rate retains 5%, and how much are you willing to pay for the share today? So price the share, right? So we use the general form of the dividend model. So now, first of all, look at the return here. The required rate of return, we're going to use as a discount rate, right? So we have to be ensure that this is the we need to use the effective rate, right, for the discount rate. So can you tell me the 5% per annual, is that an effective or nominal rate? Anyone can record? Nominal? There is actually an assumption here, as we mentioned, that if we don't mention the compounding period, right? Obviously, if you check this 5% per year, it doesn't mention compounding, right, differently, like a compounding monthly or compounding quarterly. So if you don't mention that compounding period, or we don't have the information, we just assume this is effective rate, right? So 5% is the effective annual rate. Okay, 5% per year, compounding yearly. Okay, effective annual rate. Now, next question is that cost of capital 5% per year compounding annually is the desired effective rate for this calculation, or any other effective rate you need to use? Right, we have different effective rate: effective quarter, effective month, effective annual. Which one will be used in this case? Anyone? Effective annual, effective quarter, effective semi-annual, semi-annual, right? How can we tell that? Check the frequency of cash flow. Okay, dividend is paid every 6 months, so cash flow is per 6 months. You have to use the effective rate for that 6 months, which is the effective semi-annual rate, right? So that's why the first step to convert the effective annual to effective semi-annual. and the 5% is effective annual, right? We're going to use the long and short interest rate model. We don't use the JLVM because 5% is already effective rate, right? And the rest, right, quite straightforward. Once you figure out the effective rate, first the dividend 0.5, right, the next dividend, and also the share price. That's the cash flow for the equity sale. Okay, $12.39. Okay, and also one thing is quite important is that any pricing issue, as mentioned, is forward-looking. You only include the dividends that expect to pay. It's not the dividends in the past. Okay, anything in the past will not be included in the model. Only the dividends that will be paid in the future, okay, should be considered for the equity pricing. Right. So this is a very general case. Right. We have different dividend payments. And however, think about the reality, the case in the real world, right? So usually you may actually hold a long term and you may receive multiple dividends, right? The problem is if we calculate the present value for multiple dividends, it's just a manual work. You have to calculate the present value individually, right? And then sum them up. And there could be some models or say an easy way to calculate the present value if the dividend follows a specific patterns, right? Such as the annuity pattern, perpetuity pattern, right? So in this case, we actually have 3 different types of dividend patterns. And the first one is very simple. It's just a constant dividend, okay? So this is just the assumption, or we say just the one potential case in the real world, constant dividends, even though it's really rare to see like people pay constant or company pay constant dividends. So the first one is very theoretical and very, let's say, simple, just the constant dividend. So every period, the dividend will be the same number, right? So how do you calculate the present value? You just use the perpetuity model, so C over I, right? C over I in the dividend growth model, C is the cash flow, periodical cash flow, which is dividend payment, and I, right, is the cost of capital, which is KE. Okay, so that is very straightforward. So let's look at the example here. So a share that has just paid its annual fixed dividend 0.35 and discount rate is 7% per year, assuming the company will pay fixed dividends forever. Okay, right? So let's look at the discount rate, 7% per year. Right? You need to identify whether this is a nominal or effective. Is that effective or nominal? We don't have the compounding period information, right? We assume this is effective. So effective annual. Is that effective annual the desired effective rate for this case? Right, because the dividend is annual fixed dividends. Dividend is paid every year. You need the effective annual rate. So that's why we use that 7% directly. Okay, so that's a very simple one. Another pattern, right? Another pattern is the constant growth in dividends. So dividends will not be constant a long time, but the growth is constant. Okay, the dividend will grow at a constant growth, and we can also use a formula to simplify the calculation. That's the second type, constant growth in dividends. Right. So general form for this to calculate the present value. So G is the growth rate, right? D0, that's the dividend has just been paid, and the K is the cost of capital. And we can simplify this long equation, or the long expression, into the following simple one. Okay, you don't need to know how to derive that. Okay, so for the constant growth in dividends, the price is just, so either one will be okay. D1 means the dividends in next period. Okay, dividend in next period. D0 means the dividends has just been paid. That's the dividends in the past. And the KE minus G. So KE, cost of capital, G is the growth rate. Okay, growth rate. So that's the formula. Very simple one. An example. Estimate the value of share that has just paid an annual dividend 0.35. Growth rate is 5%, and the required rate retains 7%. Okay, so people might make mistake for the numerator. So someone may just use the 0.35. Remember, in the numerator, it should be the dividends in the next period. Or we say the next dividend. 0.35 is actually dividend in the past. So that's why you have to use the 0.35 multiplied by 1 plus G. And this number, this term, will be the dividends in the next period. Okay, D1. Don't use D0. Okay, so by looking at this example, let's say, let's just have some extension here. So let's say, what if the dividend growth rate is 8%? Right, it's possible. Right? It's possible that the growth rate is greater than the required rate return. So what's going to happen? Going down? Yeah, based on the equation, obviously you will get a negative, right, price. But is that realistic to have a negative price? No, right? So actually, if you want to use that simple equation here, simple expression, there's an assumption the growth rate should be less than the cost of capital. Okay? Otherwise, if the growth rate is greater than the cost of capital, it just means that the price will be infinite. Okay, price will be infinite number. All right, because the growth rate of the dividend is so large. Okay, you will receive the very large dividends in the future. When you discount it back, it's still a large number. Okay, so that's the assumption here. The growth rate should be less than the cost of capital, and you can use that expression. Otherwise, you have to follow the initial long, right, this long expression. So that's the second type, constant growth in dividends. And the third one, so more complicated if you look at the formulas. So this is the variable growth in dividends. Okay, and this is quite a practical, intuitive, right? Think about the companies. They actually have a different stage, right? Early stage, a high growth stage, and also in the material stage, quite stable. So usually the variable growth in the dividends is, there could be a high growth stage and a low growth stage. So here we just look at the two stages. It can be more complicated, like 3 stage or 4 stages. So you have two different growth rate. And the first stage is the high growth rate, is the G prime. And the second stage is the low growth rate, is G. Okay, it's a low growth rate G. And then this formula calculates the present value for that dividend cash flow plotted. And also you don't need to memorize this formula, just to know what is the right number, right, to for each parameter. D0, that's the dividend that has just paid in the past. KE is the cost of capital. G prime, first stage growth rate, and G is the second stage growth rate. And K, there's a new one, K here, is the number of dividends payment in the first stage. Okay, number of dividend payments in the first stage. So probably you may go through this example and then you may get familiar with this formula. I will give you around 5 minutes, all right, and try to plug in the number into this price equation. Okay, just get familiar with that input. All right. All right, so for any question in the test or the assignment, the difficult part is not the formula itself, right? It's actually about how to find the right number for each input. right? So did you get the same number? 11.75. So D0 $0.9. That's the dividend just paid. Right, in the past, first stage grows 10%, second stage grows 6%. And there's also an assumption for this equation. The second stage growth rate should be less than the required rate return. Okay, the second stage growth rate should be less than the required rate return. So it doesn't matter the first stage growth rate. The first stage growth rate doesn't matter. It can be a high number or low number. But the second stage growth rate should be less than the required rate return. All right. So that's the three types or three different dividend patterns. We're going to have different models. Obviously, in the real world, the dividend pattern will be more complicated, and even some companies, the dividend cash flow pattern is really hard to predict. And obviously, we can just use some model by assuming that we have a more simplified, in the theoretical, from the theoretical point of view. Right. So now, think about how we implement the dividend growth model, in the real world. Let's just assume we're going to use the constant growth dividend model. Right? You want to evaluate the value of Apple company. Right? And we know the formula. D0, multiplied by 1 plus G, that's the estimation of next dividend, and divide by the difference between KE and G. Right? So we know what information we should look at. First of all, D0. Where can we get that information? If you want to implement this model, right? Where can we get that information? Or do we have the access to this information? D0 is the dividend paid in the past, in the last period. And this information will be available to all the investors. You can check their official website, They may have some announcement in terms of dividends payment. You can check the financial statement. They will also disclose that information. So D0, you can get, And then KE, the cost of capital, how we get that information. So this part actually, KE, how we get the KE, cost of capital, will be discussed in the module 4. Usually we're going to use some kind of like a combination of cost of equity and the cost of debt, and we need more information like the financial leverage, and that information will be discussed in the module 4. So let's just assume you already have the information of KE, and the unknown information here is the G, growth rate. So how can we get the information, the growth rate information? Where can we get that information?
It should be the growth rate after the last change in the dividend growth. So it's go with a constant rate.
Okay, based on the constant growth assumption, we can actually check the growth rate in the past. We check the dividends for the past 10 years. Look at the growth rate, and that growth rate could be a good proxy for the growth rate of the dividends in the future. Or alternatively, if you want to use some forward-looking, you can look at some, let's say, the analyst forecast. Some professional investors, they will actually forecast their dividend growth in their report and make some recommendation You can also look at the official website, because some of the management team members, like CEOs, they will also give their own estimation in terms of the firm's prospect, or probably the dividend or cash flow, or like the sales, or even the net income, we said the profit growth. So that's the sources that you can rely on to get the information. And theoretically, we can also estimate the gross information, okay? We can also estimate the dividend growth information. So first of all, you have to be aware, where does the dividend come from? You have to get familiar with the income statement, right? Remember, I'm not sure whether you know the structure, right? The first item is the sales, that's the cash inflow, and then you deduct the expense, right? The cost, the tax, and the last item is the net profit. That's the income to the shareholders. So that part, net profit, the company has discretion to decide whether they want to pay out as dividend, or they can retain that part of money in the firm to support the future investment. So that's why if you decompose the company earnings, or we say the company's profit, it will be dividend or retained earnings. Okay? The portion of the capital, the portion of the earnings that has been paid out as dividend, and the remaining portion of capital may be remained in the companies to support the future investment. Right? So actually, we can calculate the dividend by using the earnings information. So dividend equals the earnings multiplied by the dividend payout ratio. So dividend payout ratio is the portion of the capital of the earnings that will be paid out as dividends. Okay? And sometimes you may also heard another term, the retention rate. Okay, clawback ratio. That means the portion of the earnings that will be retained in the companies. Okay? So now look at this equation. Dividend equals the earnings multiplied by the dividend payout ratio. Okay? So if you have 1 million earnings, you want to pay 500,000, it just means that the payout ratio is 50%. And if we assume the dividend payout ratio is constant, we don't assume the dividend is constant. We just assume the dividend payout ratio is constant. We always pay, let's say, 50% out as dividends. Then, if you look at this equation, any change in dividends is just due to the change in earnings. All right? If you have more earnings, you will get more dividends because the dividend payout ratio is constant. If you have less earnings, you will have less dividend. All right? So the change in dividends is 100% from the change in earnings. That means if we are able to estimate the earnings growth, we can use the earnings growth to proxy the dividend growth. Okay? So that's the main idea. So how we get the earnings growth? So earnings growth is the change in earnings divided by earnings, right? That's the ratio here. So incremental in earnings divided by the earnings in the past period, we can know what is the earnings growth. So when can we have the change in earnings? When we can have an incremental earnings? Because the company launched a new project. The companies launched the projects that brings positive NPV to the company, right? That's why the firm value will increase. So the change in earnings is just from the new investment, the new project, right? So if you know the information of return on investment, and that return on investment multiplied by new investment should be the incremental earnings, right, to the firm. And the new investment, how can we know the new investment? Here is the assumption. Remember, we retained portion of the earnings as to support the future investment, right? So here we just assume the new investment is 100% supported by the retained earnings in the last period. Okay, we have money to support the new investment because we retained some earnings in the past. And obviously in the real world, right, it's not necessary you use your own money, right, for the new project. You can have the financing events. You can have equity financing. You can issue bonds to support this new investment. So anyway, the new investment is from the retention rate multiplied by the earnings in the past periods. That gives you the retained earnings. And that retained earnings is for the new investment. So finally, you find the earnings, right, in both numerator and denominator. You cross them out, and you can get a simple term. The earnings growth is the retention rate multiplied by the return on investment. Okay, so you don't. I just illustrate how we get this term, but you don't need to know how memorize how we derive that. That will not be exempt. So basically, what information you need to use is this equation. Earnings growth is actually the dividend growth equals the retention rate multiplied by the return on investment. That's another appropriate guess for the dividend growth. Okay, so retention rate. So earnings will be paid out as dividend, or it can be retained, right? And the portion that will be retained, the portion of the earnings that will be retained is called the retention rate. And the portion of the earnings that will be paid out as dividend is called the payout ratio. Okay, payout ratio. So that's how we get appropriate guess on the dividend growth, right, from a theoretical point of view. Right. Okay, so dividend growth just equals to the earnings growth is the retention rate multiplied by the return on investment. Right, so probably let's look at some practice, and in terms of the dividend model, dividend growth model. All right, so let's look at the question 2. So this company expects to have an earnings per share of $6 in the coming year. Rather than reinvest these earnings and grow, the company plans to pay out all its earnings as dividend. And with the expectation of no growth, Crane's current share price is 60. Okay, so that's the first plan for this company. The company will not pay. Will pay out all of its earnings as dividends. So payout ratio is 100%. Right? So if you pay all as dividends, it means there's no capital retained in the company. There's no way that you can, right, launch new project for the company. So that's why you will have no growth. With the expectation of no growth. And currently, this company's share price is $60. Okay? Now, another plan. So this company can actually cut the dividend payout ratio to 75%. Okay, from 100% to 75%. And use the retained earnings to open new stores, right, to have new projects. And the return on new investment is 12%. And if you assume the risk of new investment is the same as the risk of its existing investment, all right, so that information is also important. If the new investment risk is the same as the existing investment, it means that the required rate return from the investor will not change because the risk is the same, right? The required rate return will be the same. And actually, it has been highlighted. The firm's equity cost of capital is unchanged. Now calculate the new price, and obviously the value of the growth option. So just calculate the new price. So new price means the price based on the second plane. Right. Okay, so probably we can work on it together. Let's look at the first plane. Let's have the plane A. The plane A, no retained earnings, and every period you're going to receive $6 as dividends. Right, $6 as dividends. Because the earnings will be $6 and you pay all of the earnings until end. So this is actually a constant dividend, constant dividend pattern, right? Remember the formula we can use? We use the perpetuity model to price, right? This type of dividend. So P0 equals D0 over KE, right? Now we know we should use this formula. So P0 is actually given because currently the price is $60. So that is given. And D0 is also given, $6. KE, required rate return from the equity investor. We don't have that information, right? But based on the first plane, we can imply this cost of capital for the, obviously, the required rate return for the equity investor. All right. So for the first plane, we are not calculating the price. We actually calculate the required rate return, okay, from the equity investor. So from the first plane, we can imply that the cost of capital is 10% per annual. Right. So 60. Right, that's 6. You calculate the new denominator. That should be 10%. Any questions on this part? Any questions? All good? Okay. So that's the that's for the plan A. So now think about the plan B. So plan B now will be different. We cut the dividend payout, right? We cut the dividend payout. We have money. We have retained money to support the new investment. So new investment will bring more cash flow, more income. So your dividend will actually grow, okay? And here, we have the constant growing rate. So let's just say this is D1. And next period will be D1 1 plus G. And this is a D1 1 plus G to the power n minus 1. All right. We're going to figure out the numbers later. So here I just want to show you this is a constant growth, right, dividend pattern. Okay. So constant growing or constant dividend growth, right? What is the formula? So P0 is D1 over KE minus G. Okay. Now we found the right model, right? The constant growth model. Now find the numbers for each one. First of all, for D1. What is D1 in this case? The next dividend payment. That's right. So $6, that's the earnings, expected earnings next period, multiplied by the payout ratio, which is 75%. and that will be $4.5. Okay, so compared with the plan A, you pay a lower dividends initially, but later on you will pay actually larger dividends in the future because the dividend will grow at a constant growth rate. So now we figure out D1, 4.5. So KE, cost of capital, will not be changed even though you take new investment, right? So we still use 10%. Then what's the growth rate? Growth rate for the dividend. And we have to use this formula, all right? Retention rate multiplied by the return on investment. So retention rate, what's the retention rate? 25, all right? 75 is the payout. It means the remaining portion will be retained, so 25%. And the return on new investment, that's 12%. And this will be 3%. Okay? And the price we get is 64.29. All right, 64.29. And what we can tell from this example, you can see that the dividend policy actually will influence the firm value. Okay, so dividend policy means that because the company has discretion to decide how much you're going to pay out as the earnings as the dividends. So the dividend policy is actually related to this number, how much you're going to pay out. Okay, so you can pay out 100%, you can pay out 50%, you can pay out 75%. And you can find that different payout policy will actually influence the firm value. Right? So for example, currently, if the company chooses 100% payout ratio and the price is $60, okay? And then the company announced that they will cut the payout ratio to 75% and the price will jump to 64.29 right away. Okay, assuming all this information will be available to the investor. Okay, investor aware that they will take new projects and the return on new projects will be 12%. There could also be the case that even though you cut the dividend payout ratio and the price actually will be lower than the previous plan, right? Only because you take the round project, right? The projects give you a negative NPV. And how can we tell that? You can directly compare the return on the new investment and the required rate return from the equity investor. So return on new investment, you can view that as a return, right? That's the return. The required rate return on the equity investor, that's actually the cost for the company. Okay, the required rate return from the equity investor, that's actually the cost for the company. It means that the company has to pay 10% per year to get the money from the equity investor to support the new investment. But if this new investment can bring you 12% as an annual return, obviously the company can make profit because the return is greater than the cost. But if the return on new investment is less than 10%, so you can try that number and calculate that. So if the return on the investment is less than 10%, it means that you pay more, right, to support this new project. You don't get any profit. Then NPV will be negative. Okay. So that's about the equity financing. Here I just want to probably highlight some drawbacks or shortfalls for the dividend growth model. And that's also related assumption. So you have to be aware that in the real world, there are many firms do not pay dividend. Right? For example, in China, there are many companies, they don't pay dividends. So if they don't pay dividends, you're not able to use the dividend growth model. All right? And also, the dividend is really hard to forecast. we have a very like a theoretical assumption, assuming that the dividend growth can be constant, or even though the variable growth, there was only just the 2 of 3 stage. But in the real world, that dividend growth, or we say the dividend growth may not be constant, may change all the time. Okay, and dividend may not be constant. So if the dividend payment is so volatile, it's really hard for us to predict the dividends in the future. And that will also introduce the buyers when you use the dividend growth model. Okay, so what kind of firms that will be appropriate, that the dividend growth method will be appropriate to be used? Usually will be those material companies. Okay, they're quite stable, and their dividends are, as we said, are easier to forecast or predict. Okay, we actually have other ways. So discounted free cash flow method, we're going to discuss in the module 2, and the multiples you may come across in other finance courses, so we don't spend too much time on this point. Next is about the bond evaluation. Okay, short-term bond. First of all, short-term bonds. Short-term bonds, some example, the commercial paper, bank bill, bills of exchange. So here we have 2 example, commercial paper and bills of exchange. The difference between these two is just related to credit rating. So bills of exchange does not have a credit rating from a rating agency, so usually will be risky. But they share the same form of pricing, okay, bond pricing. So this is pretty much similar to the future value and present value with the simple interest rate. And also you have to remember that for the short-term security we use the simple interest rate. For the long-term security we use the compounding interest rate. Okay, so in this example, the commercial paper example, the R here is the simple interest rate. Okay, the simple interest rate. Right, so look at this example. The formula, P is the price. Okay, the price. F is the face value. Okay, and R is the yield on this commercial paper. And D here is the number of days to maturity. So I'm gonna interpret each by looking at the following example. Okay. So F face value, R is the yield based on the simple interest rate, and D is the number of days till maturity. Okay. So look at this example, a 90-day commercial paper which has 500,000 face value, a yield of 4.926%. What is its price? Right, so all the numbers, so 90 days, right, that's the value for D, face value 500K, and yield 4.926%. Right, how we interpret this one? It just means that we're gonna pay $493,999.33, right, to have this commercial paper, and 19 days later, I will receive $500,000. Okay, you only receive one single cash flow for the short-term security. So you pay this much by expecting to receive $500,000 90 days later. Okay, and for that 19 days investment, your annualized return will be 4.926%. Okay, this is an annualized return. That's how we interpret this number. Face value is what you expect to receive at the maturity. And this number will be written in the contract. Okay? And the P here is the price you're going to pay to get the commercial paper. And that R will record the yield, or we say the return, annualized return you can get for that 19 days investment. Okay? Right, so probably we can still have another practice. So just to get familiar with this formula, let's look at the question 4. So this is a bank bill, issued a 19-day bank bill, and the market year was 6.35 when the bank bill was issued. And David purchased this bill when it is issued, and then David only hold 30 days and sell it 30 days later. And at that time point, the market yield was 5.85% per annum. So what is the return for David's investment? Okay, so to calculate the return for David's investment, you have to know at what price David paid, right, to get this commercial paper or bank bill, and also at what price that this bank bill has been sold in the market. Okay, so that's how we calculate return. So let's assume the price that David paid is P0, and the P1 is the price that David sold his the bank bill in the market. All right, so how we calculate the return? P1 minus P0 over P0, okay? That's how we convert the price to the return. Right? If you can sell it at a higher price, P1, then you can get a large return, right? So now we have to figure out P0 and P1. So P0, right? That's how we determine the price. So we need to have the face value, we need to have the information of yield, and also the date to maturity. Okay, so that's how we price the bond, the short-term bond. All right, follow this equation. Face value, $1 million. And 1 plus R. R is the interest rate, right? The simple interest rate at that time point. So that information has been given 6.35% per year. All right, so that will be 6.35%. And multiply by D over 365. So D is the number of days till maturity, right? So this bank bill was issued at time 0, and maturity is 90 days later. So that's why D1 is 90. Okay, 90. So how many days till the maturity? And that will give you so 984 583.84. Okay, so that's the price when the bank bill is issued. And next is P1. The price is always determined by this equation. Okay, so still face value $1 million. So face value will not be changed. It's written in the contract. Okay, you are sure to get $1 million at the maturity. And then 1 plus, now at the 30 days later, the market yield is actually different. It's 5.85. You have to use the simple interest rate at that time point, the annualized simple interest rate. So 5.85. Okay, and then multiply by the 2 over 365. Right, so what's the value for D2 now? 60 or 30? 60, okay? So remember, D means number of days to maturity. So P1 is actually occurred 30 at day 30, right? There will be 60 days till maturity. All right, so how many days left until maturity? So D2 will be 60. That will be 994.75.16. All right, so that's the price at day 30. So first of all, you have to know the return we're going to use, the annual. That should be a simple interest rate, right, at that time point, the market yield at that time point. And D means the day until number of days till maturity. Okay, it's not number of days, right, after the issuing date. Can anyone guess what should be the price of the bond? Just, let's say, just 1 hour before the maturity. What could be the price of this bond just 1 hour before the maturity? It will be very close to face value. Okay, it will be very close to face value. All right, because you only get the interest for that 1 hour. Okay, you only get the interest for that 1 hour. All right, so we have to continue our calculation. The return will be so we use these two numbers. We can get 0.6%. Okay, that's the return. Well, how we interpret this number, 0.6%? This is not an annual return. This is just the return for David's investment. And remember, David only hold this investment for 30 days. So what it means is that this 0.6% is the 30 days return. Okay, 30 days return. It's not an annual return. Usually, we will annualize any return so that we can make comparison for different investments. So the last step is to annualize this return. Make this number to an annualized number. So what we can do, we can have different ways. We can use the compounding way, right? And also the simple interest rate. And the compounding rate is preferred, all right? So compounding rate, this assumption here means that this investment opportunity, this 30 days investment opportunity, you can have it again and again for the whole year. Okay, you can have it again and again for the whole year. So that will be 1 plus 0.6%, right, to the power 365 over 60. Oh, sorry, it's 30. So the value for the power here just refer to the number of this investment opportunity you can take for the whole year, right? So you can have it again and again, and that will be 7.55%. Or you can also use the simple interest rate, and that will be 0.6% multiplied by 365 divided by 30. And that will be 7.3%. Right, so either way is fine. But compounded interest rate way will be preferred because sometimes you also need to compare the investment, the short investment with the long term, right? You have to be consistent. So compound interest, so 7.5% or 7.3%, both are okay. All right. So that's how we analyze this return. Okay. So that's about the question 4. That's the short-term bond. All right, let's move back to the long-term bond. So how we price the long-term bond. The long-term bond here, the first example is the bank loan. We actually discussed that in the last workshop. We used the annuity model, right, to calculate the monthly or bi-weekly repayment. And here, if you want to price the loan, it actually goes the other way around. So assuming that you have the information of monthly or bi-weekly payments, the interest rate, the term of the loan, and you calculate the present value. And that's the value you're going to have. That's the value for the bank loan, right? This also works for the balance owing calculation. Okay, so how much you still owe to the bank, that's what you can use. So we don't spend too much time, and also there's an example, you can look at it by yourself. The key point here we want to discuss is the corporate bond. So corporate bond does not like the short-term bond that give you one single cash flow in the future, right? A lump sum cash flow. So the corporate bond also will make some periodical cash flow, we say the income or cash flow to the investors, and that's what we call the coupon payments. Okay, coupon payments. So if you look at the timeline, right, visualize the cash flow pattern. So once you pay the price to get the coupon bond, right, this is the cash flow, and negative means the cash outflow, right? And you will expect to earn the coupon payment every period. Okay, every period. And at the maturity, you will have in addition to the coupon payment, you will also have the future, the face value payment, right? That's a lump sum payment. So if you want to price this bond, first of all, look at the coupon payments. That's periodical payments. And this coupon payment is usually fixed, all right? It's a constant number. So that's why we can use the annuity model to calculate the present value of all the coupon payments. And the last, at the maturity, there was a face value payment. Since just a single cash flow, we can use this, right, present value and the future value formula. To calculate the present value of this single cash flow. All right, so that's the model for the corporate bond or coupon bond. And now, usually for these coupon payments, we said every period, right? In the real world, company usually will pay the coupon every 6 months. Okay, coupon payment every 6 months. It means that if you want to value this bond, you need to have an effective semi-annual rate. Make sense? Right? You have to be consistent. So coupon payment is every 6 months. You need to use the effective semi-annual rate. Right? And the following example, just a simplified version, we assume the coupon payment are made annually, even though most of the firm will pay coupon every 6 months. All right? So let's look at the example, just get familiar with this formula. So coupon payment, a face value 4-year bond with a face value of 100,000, a coupon rate of 9%, assuming that the appropriate required rate return is 8% per year, and coupon payments are made annually, can you calculate the bond price? So look at the required rate return is 8% per year. Without compounding information, that should be the effective annual rate, right? And the coupon is paid annually, so the effective annual rate is the desired effective rate for this case. And now we look at the periodical payment, which is the coupon payments. So how we calculate the coupon payment is usually the face value multiplied by the coupon rate. And this number will be written in the contract. Okay? So face value multiplied by the coupon rate. Okay, not the price of the bond multiplied by the coupon rate. It's the face value. Right? The price of the bond may change at different time points, but the face value will not. So that's why the company will give you a fixed coupon payment. So in this case, 9% multiplied by face value 100,000, so $9,000 as a coupon payment every year, and you got a 4, so you can use the annuity model to calculate that 4 coupon payments, the present value, and at maturity year 4, you will also get a single cash flow 100,000, right? And then you calculate the present value and sum them up, you get the price of the bond. Okay. So now let's just change this coupon rate to 8%. Okay, for you to practice. For you, there's a practice for you. So let's change the coupon rate to 8%. Can you calculate the bond price for me? Right, we only need to change this coupon payment from 9,000 to 8,000. Right? Anyone get the number? Yeah, what's that? 100,000, right? That's the same as the face value. So that's actually related to some financial term, we say the terminology for financial for this bond selling. So if the bond is selling at the face value, we just call it selling at the par. Okay, selling at a par. And if the bond is selling, the price is less than the face value, we just say selling at a discount. And if the bond price is greater than the face value, we just say selling at a premium. But how can we tell whether it's selling at a discount or at a par or a premium? That's related to the coupon rate and the required rate return, right? So if this coupon rate is the same as the required rate return, in this case 8%, then you can find the face value. The price is the face value. And if you're back to the previous example, 9%, right? The required rate return is lower than the coupon rate. The price is higher than the face value. That's the setting on the premium. And if the coupon rate is less than the required rate return, you will have a price less than the face value. That's the setting at discount. So sometimes you will not be directly given those information. They just say, okay, this bond is selling at a par. And then you should be aware that the coupon rate and the required rate is the same. Okay? Okay. The last point, the term structure. So term structure describes the relationship between the term to maturity and the interest rate for the debt security in the same risk class. And sometimes we call it the yield curve. Right? For example, if you want to make a deposit in the bank and you negotiate with the bank for a 1 year deposit, that will give you 4% per year. Okay, you're going to earn 4% as a return. Now, if you make a longer investment, let's say 2 years, you will get a 6%. So that 6% is not for the 2-year investment. It's still an annual return. It means that every year you're going to receive 6% for 2 years. Okay? And the third one, 3 years investment, every year you're going to get 8%. So the longer the investment period and the higher return you can get. Okay? And this, if you want to plot the term to maturity and this annual return, right? This is what they call the term structure. The relationship between the term to maturity and the yield. And in this case, you can find this is upward sloping, right? The longer the investment horizon or longer the investment period, the higher annual return you can receive. But there could also be some other case, like the downward sloping curve, even though it's hard to or rare to observe in the real world. The downward sloping means that the longer the investment, the lower annual interest rate you can earn. Right? So does anyone know at what time we may observe the downward sloping curve? Right? It's very intuitive to have upward sloping. Longer the investment horizon, the higher annual return, right? Because you lose the flexibility. You have to lock in your capital for a long time, right? So when we may have a downward sloping. We actually experienced that in the past 2 years. So downward sloping usually will occur just prior to the financial crisis or economic crisis. Okay, why is that? Well, if people can foresee the economic crisis, it just means that the investment environment will be uncertain, right, in the short run. Everything will be uncertain. You will not know what could be the return for an investment just in the short run. And that will result in, so that's why they will prefer the long-term investment, because they can lock in the same rate for long term, right? That will reduce uncertainty. So people will rush into the long-term investment, right? That will result in excessive demand for the long-term investment. Okay, excessive demand for the long-term investment. And you know that for the demand and supply, if there's a large demand, that will push up the price of the long-term bond. Every bond will prefer the long-term bond, that will push up the price of the long-term bond. So the price is higher means that you have to pay more to get the long-term bond. Obviously, the expected return on that long-term bond will be lower because you pay more. Okay? So that's the reason why we have the downward sloping. People will prefer the long-term bond to avoid the uncertainty, and the price will be pushed up. Your expected return will be lower. So the yield will actually be lower for the long-term bond just because there was an excessive demand for the long-term bond. Okay? We also have several other theories to explain the yield curve. The expectation theory, we have some calculation problems. So expectation theory just means that this term structure actually implies the investor's expectation of the return for the future investment. And the risk premium theory, so people believe that the long-term bond or long-term investment will involve more risk, right? Think about the liquidity issue, right? Think about the flexibility. As we mentioned, that you have to lock in your capital for a long time, right? And then you actually may miss some good investment opportunity in the short run, right? And that can also be viewed as kind of like an opportunity cost, okay? And also the inflation may be higher, the interest rate might change for a longer period, and this risk may also be priced in that yield. So usually the yield curve is upward sloping, like the long term will have to long-term bond investment. The investor will expect some premium to compensate for this risk. So that's why the return will be higher. So now let's look at the key point, the expectation theory. So expectation theory, as mentioned, it actually implies the investor's expectation of future, the return of the future investment. All right. Usually we can start with the example to illustrate this point. So think about two different investment options. One is a 2 one-year government bond in a sequence. And the second investment option is a 1 2-year government bond. And these two investment options should bring the same result. Right? If you draw the timeline, the first one is you make a 1-year government bond investment, and you harvest your investment 1 year later. You use all the proceeds for another 1-year investment. Okay? And that will give you, let's say, a future value. And the second investment option, you make a 2-year investment, and that will give you the same future value. Okay? So this is 0, 1, 2, and this is 0, 2. By having this equation here, we just can say, why we say this is expectation, because based on this equation, we assume that these two will give you the same results. So based on these two equations, we actually imply the potential return we can earn on the second investment in the first option. Okay, remember, this second investment is actually in the future. It's not starting from time zero. It's not from now. It's actually 1 year later. So 1 year later, everything may change. Market information may change. Market interest rate may change. So no one can know what should be the return you can have when you make an investment 1 year later. Okay, you can only have an estimation, or we say the projection, or we say the expectation. And by having this term structure, we actually imply our expectation on this return. Okay, so usually we will use a different way to denote the return for different periods. For example, 0 to 1, that's R01. It means that if you make an investment starting from time 0 and maturity is 1, and that should be the annual return for that investment. And here, for this investment, we use R02. So this investment starting from time 0 and end in year 2, and R02 is still an annual return. Okay, it's still annual return. All right. So what information is available to the investor is actually any return that is starting from time zero. That's the term structure. That's what we can observe in the market. For example, if you look at these three numbers, this 4% is actually R01, R02, this is R03. So any investment you want to make now, right, even though you have different investment term, that's the return you can get. Okay, that's the return you can get. But for this investment, from year 1 to year 2, R12, that's the investment you're going to make in the future. And this return, you will never know. It's not available to the investor. Because 1 year later, no one can guarantee what's going to happen. No one knows what's the market condition. So R12, it should be your estimation. Okay? You can only estimate what could be, what might be the number. But there is no information about the true return 1 year later. So that's why, from the expectation theory, this term structure will actually implies the return for any future investment. Okay, any future investment. So probably we can look at the practice we have here and see and get familiar, just have the basic idea about the term structure. So here we have 5 interest rate, annual interest rate. All right. So years to maturity, which is 1, then the corresponding interest rate is 6%. So this is actually R01. If you make investment right now, 1 year later you can get 6%. And R02, that's the R02. If you make an investment now and ends in year 2, you can get 6.5% as an annual return. Okay, and all this information will be available to the investor in the market. All right. So that information will be available to the investor. Now you need to calculate the expected 1 year spot rate for the second year. Okay, so 1 year spot rate for the second year means that what is the return of an investment that is starting from next year? Okay, from year 1 and end in year 2. That's the spot rate, 1 year spot rate for the second year. Or we can also say R12. Okay, 1 year spot rate means that we need a 1 year rate, annual rate, and starting from next year and end in the second year. And remember, this is the return on the future investment, so we use the expected. There is no guarantee, all right? So this term structure actually implies this expected return on a future investment. All right, so how we can solve this one? And for any, let's say for any term structure problem, you can always think about the 2 investment option. All right, so in this case, you can make 2 1-year government investment, and you can also make a 1 2-year investment, and that 2 investment option will yield the same result. So let me just denote it as A, and this is B. So for A here, right, so 1 plus R0, 1, that's what you can get, right, at the end of year 1. You start with $1, and that's how much you will end up for the first investment. And then you use all the profit for the second investment, right? And that second investment is in the future, so R12. So this is the future value for the first investment option. And the second one, second investment option, you make a 2-year, 1 2-year investment directly, and that should be the future value for the second investment option. And these 2 investment options will yield the same results. So A will equal to B. And we already have that information for R01 and also the R02. you're able to calculate R12 by having this equation. Okay. Let me just show you. So that will be plus 6%. Plus R12. 6.5%. R2. So R12 is 7%. So it means that any investment that is starting from next year and end in year 2, we expect to earn 7%. Okay, and that's based on the term structure, the information we have at time 0. Right? There's no guarantee that that investment 1 year later will be 7%, but this is just our expectation. Okay, our expectation. So return on any future investment. So return on any investment that's starting from not from 0, you will never know the true value until you approach right to that time point. You can only have an expectation. So you can also, for example, let's calculate 1 year spot rate for the 5th year. Can you calculate the expected 1 year spot rate for the 5th year? So what we can do for this one? All right. So for any questions like this, you can always think about the 2 investment option, right? So how we construct the 2 investment option in this case? So first one, we can think about a 4 years government bond investment. Okay, 1 4 years government bond investment. And then 4 years later, we're going to have another 1 year government bond investment. And that will yield the same result if we directly make a 1 5 year bond investment. Okay? So first option is about 2 investment. The second option is just 1 investment. These 2 should yield the same results. Right? So now you can set up equation. So 1 plus R04 to the power 4. Right? 1 plus R45. And this is 1 plus R05 to the power 5. And these 2 should be the same, right? If you look at this interest rate, R45, it means that we're gonna have an investment 4 years starting from year 4 and end in year 5. Okay, obviously that's an investment in the future. It's not right now. Okay, so we don't have that information, but we can get an expected return based on this term structure. Right, so you can make these 2 equal. R04 is given 7.2%, R05 7.4%. Okay. Just leave it for you to go through. If you have any questions, just let me know. I don't have the numbers here. The last one is explain why it's not possible in the market for the 6-year zero coupon interest rate to be 6% per annum. So now let's assume the 6-year zero coupon interest rate to be 6%. Is it possible or not? So we don't have that, right? The 6-year zero coupon interest rate in this table. But if you assume that's a 6%, is that possible? Is there any way we can have some arbitrage profit? So how we can do that? The same idea. Right, the same idea. Think about the two investment option. So A and B, right? Remember when you deal with the expectation theories, always think about the two investment option, and they should yield the same results. So the first one, R05 to the power 5, right? You have two investment, and then use all the process to make another 1 year investment, 1 plus R56. And this will give you the same result if you make it just a 1 6-year government zero coupon investment. And these two should yield the same result. Right? So if we assume that the 6-year zero coupon interest rate is 6%, if we assume this is 6%, and we have that information for R05, 7.54%, you're able to calculate R56, which is the 1 year spot rate for the 6 year. And if you plug in the number, you will find that the R56 is a negative number, which is not possible in the real world. So that's why it's not possible to have 6 year zero coupon interest rate for the fixed 6 year. Okay, so that's about the term structure. So when you come across any term structure problem, always think about the two investment options. They will bring you the same results. Okay. Right. So that's about the workshop questions. There was another one. Yep. There's another point I want to highlight. Is about the relationship between interest rate and bond value. And think about how we price the bond, right? Usually the yield or interest rate is in the denominator, right? A higher return means that you will pay lower. The price will actually be lower. You pay lower to get a bond, obviously you can get a higher return, right? The lower you pay, the higher return you're going to receive. So there is an inverse relationship between the market interest rate and the bond value. So anytime you can observe in the real world, when there is an interest rate increase, the price of the bond will drop immediately. Okay, so that's a very important issue here. The interest rate and the bond price or bond value, they actually will be inverse relationship. Right, so that's the key point I want to highlight. And by the way, if you have the chance to go through the module 1, we also offer several examples, okay, in terms of the owing balance and different interest rate change and long-term change. I hope you can go through that. And if you have any question, just let me know, right? So these examples are more practical, right? So interest rate may change, and the term loan will also change. Okay. Right. So that's all for today's workshop. And if you have you got any questions? No. All right.